With our debt being so high, other people say, wow, there's actually some risk here with the United States government. And when you have this amount of debt, just like if you have a massive mortgage and you have to pay 7% instead of 3%, your payment looks a lot different. And the government's starting to feel that.
Too often entrepreneurs run around and they do this tactic or that tactic.
Yeah.
And there's no overall strategy and there's no coordination of everything. The magic is in all the things going on in your situation and having these strategies work well together.
And I think oftentimes we see people chasing what I'd call like a tax product of just something that's artificially created just to, artificially reduce taxes. But at the end of the day, to me, the whole goal is to build wealth. I mean, isn't that what we're actually in the game of doing, of building wealth, protecting wealth, managing wealth? Smart entrepreneurs know how to stack different tax strategies and structure businesses appropriately to minimize their tax burden.
We've seen business owners where they're constantly chasing revenue. I just want to make more money, make more money, but they're not increasing their EBITDA or their profit, and they're not increasing the intrinsic value of that company for a future exit.
Jim, Make Rich Real podcast where billion-dollar businesses meet billionaire strategies. We made it.
Yeah, I'm excited.
Awesome. Well, today, here's what we're going to go through. Rate cuts, yield curves, why those two things matter to entrepreneurs, and the art of stacking tax strategies. You excited?
Yeah, I am. I think all three of those have some really interesting things we can talk about.
They do. Awesome. Well, we're here in the middle of September. The Federal Reserve is expected to cut interest rates here. And before we jump into that and some things that are happening in the interest rate environment, I think it's important for us to talk through why interest rates matter to entrepreneurs. And there's a few things that I put together, but I'm curious to hear your thoughts. The first thing that comes to the top of my mind is borrowing costs. So whether it's mortgages, home equity lines of credit, security-backed line of credit, any type of borrowing that we as consumers or entrepreneurs are doing, that's going to be dictated by the interest rate environment. Second thing is valuation in stocks and in real estate, that if you're doing a discounted cash flow model, you have discount rates, interest rates, they impact that. The higher the interest rate, really the lower the value in a lot of different assets. And then also the thing that is really true, that we've seen a slowdown in the M&A market, because a lot of people don't think about this, but a lot of these mergers, acquisitions, sales to private equity companies, they're generally financed about 50% with debt, 50% with equity. And so that means private equity companies are borrowing money to then go buy middle market business owners like our clients out all the time. So if their borrowing costs are going up, it's just more expensive for them to buy companies. So if rates go down, maybe the M&A market loosens up a little bit. So those are some things I came up with. What are some other things of why entrepreneurs care about interest rates?
Yeah, well, one thing is cash. And you and I know entrepreneurs like to keep cash.
Yeah.
And one thing about cash, just as I'll do a little side thing on cash, is often I hear entrepreneurs act like, is cash trash or is cash king? And I always say that it depends, because if you have cash for a purpose, then cash can be king. If you just have a bunch of cash because you don't know where to put your money or how to invest, or you don't have a good strategy, that's not good, because over long periods of time, cash is a terrible investment. It usually underperforms inflation among virtually every other asset class too. It underperforms. But at any rate, whether you have cash for the right reasons or not is a different topic. But now that entrepreneurs have a lot of cash, what's going to happen is they're earning actually good returns in their cash right now. They might be getting 4% in their cash account, which is great. And that's actually a little higher than inflation. So they're winning the game. But as rates go down, that will start to disappear. And so not waiting until they start seeing their cash accounts go from paying 4 to 3 to 2 or whatever it ends up, start thinking about, what should I be doing with that money? Do I really have a purpose for it? It's a good time to think about that.
Yeah, interesting to hear. How do you and Mimi handle your cash? I know the rule of thumb will tell you want 3-6 months maybe of your spending in a cash account. I know for Leanne and I, we do a year, and so we have a lot of cash that sits there, but that makes her feel good, and that's just in a separate account, earning, like you said, 4%. So to your point, it's more of, is that the right thing to do mathematically? Probably not, but if it helps you sleep at night, then that's worth way more than the opportunity cost.
Absolutely. And even I've talked to entrepreneurs over the years about paying off their debt. And if they have a home loan at 3%, which some people have,
2.5%.
like, why wouldn't you arbitrage, invest that somewhere and make more money? Well, the reason you wouldn't do it is if it gives you peace of mind to have the home paid off, then that's what you should do. So for us, there's obviously the business question, right? How much do you need in the business to operate the business through the ups and downs? On the personal side, we kind of stick to that, 3 to 6 months of cash that's been around forever and feels pretty good. Mimi is not very worried about stuff. So, and neither am I, as far as like just having loads of cash because you feel better.
Right.
So I like to have a purpose for the cash. And if I get too much cash, then I start thinking, hey, maybe there's a cool watch I can buy or something else.
Yeah.
So I plan my watch purchases. And I also plan what I'm going to do with my cash because I know if I have too much in there, then just like anyone else, I'll think about spending it. So I start to say, okay, we're getting too much cash. Where should that money go? And then that's where you come in to help, when you advise us on the investment pool, like, okay, within our allocation, what are the opportunities? And sometimes I'll sit on cash because I see an opportunity coming in the future.
Yeah, makes sense. All right, well, let's go. First chart up here, Federal Reserve rate cut outlook. So as of today, middle of September here, we have a 92% probability of a 25 basis points cut. And in layman's terms, that's 0.25%. And this is from the Fed Reserve here in their overnight rates, and a 8% chance that they're going to cut interest rates by 0.5%. So that's what we're looking at now. And then as we have a second chart here that just shows a historical federal funds target rate over the last 25 years. So it looks a little bit like some hills, that it was up above 6% in the early 2000s, came down after the dot-com bubble bust, was raised up into about 5.25. That was when the great financial crisis came. Interest rates went down practically to zero. The Fed was starting to build those back up. Boom, COVID hits. You see another waterfall down, and then you can see a huge and rapid spike in interest rates from 0% up to that kind of 5.5% where they peaked, and now we're plateaued at 4.25. So we do expect, again, the Fed to cut that down to 4 or maybe 3.75% as the upper band. What are your thoughts here on the Fed cutting interest rates? There's a lot of debate. President Trump says they're too late, they're too slow.
Yeah.
Inflation data still maybe a little bit higher than people would like. Unemployment rate creeping up a bit. These are all the different factors the Fed takes into consideration. So you're the Federal Reserve. What are you doing?
Yeah, it's interesting that if you go back in history, the Federal Reserve used to be like a black box. No one knew what they were doing. And in the Great Depression, they were criticized because they didn't do anything.
Yep.
And, we had a depression for 10 years that my parents lived through. And it was terrible, right? The Great Depression is called it that for a reason. When it comes to the Fed today, the Fed is very active. People hear all the communication. I've seen the markets react based on a single sentence out of the commentary afterwards by the Fed chair. So it's changed a lot. Typically, the Fed raises too slow and cuts too slow. They're usually behind the 8 ball on this kind of stuff, and that's kind of what President Trump has been saying. We'll see if it plays out true today, but they're in a very interesting spot because they want to cut before we have a big problem in the economy, but not too soon to where we have inflation go back up. And that's a really tough, avenue to walk down to try to balance those two things out. I kind of agree with the consensus. I would bet that the Fed's going to cut a 1/4 point here at the next meeting. I do think there'll be more cuts to come. As I said, historically, what generally happens is they start cutting too slow and then they have to cut a whole bunch very fast to try to rebound. Because remember, all the economic indicators, they're really lagging. So when we find out the jobs report, it's already passed. And for that reason, it could be a scenario where the economy gets into trouble before they start cutting. But yeah, 1/4 point's coming. I think it's going to be slow and steady more than fast, unless there's a big problem in the economy, which I know real estate has really suffered through the high interest rates. I think it's going to be some time before that there's relief. And I also don't think we're going to get 3% 30-year mortgages for a long time. But everything's relative, and people are short-term rearview mirror type the way they think about things, because right now if you say a 6 or 7% mortgage sounds ridiculous compared to 3, but if it comes down to 5.5, that's going to sound like a bargain compared to 6.5 or 7.
Yeah, but a few things there, entrepreneurs. So as the Fed cuts the interest rates, instead of getting that 4.25 on your cash, maybe you're getting 3.75, maybe 3.5 as they continue to cut throughout the year. Good news is that if you've got a mortgage at 7%, I think mortgage rates are down about 6.25, 6.4% right now. And a lot of those mortgages are priced based off of the 10-year. So the 10-year Treasury rate is right now at 4%. So it's at 4.8% at the start of the year. It's at 4% today. And generally, if you're looking to get kind of a rough barometer of where mortgages are, it usually starts with that 10-year Treasury, and then you're going to add around 1.5 to 2.5%. And so again, start at 4, add 2.5, that gets you at 6.5%. Again, we're right around the 6.25% as of today. So the good news is mortgage rates have come down from that 7% peak, and the goal being that, hey, as the Fed cuts interest rates, the question will be is, yes, we know the short-term interest rates, which is what the Fed can control, will come down. Will the 10-year also continue to come down? But it has from 4.8
That's a great
to 4.
point, because a lot of people think when the Fed cuts rates, mortgage rates go down, and they're not exactly tied together, although they influence each other, but they're not tied together.
Yep, and that actually bleeds into the next chart that we have here, which is the U.S. Treasury yield curve. And what this really shows is on the y-axis or the vertical axis, it shows the yield or the percentage return you're going to get if you hold these Treasury bonds, and then the x-axis or the horizontal, it's the different years. So you can see it's like a smiley face. The red line is the current yield, and it's a smiley face. And what that means is that from the blue line to the red line, yields have come down substantially in the middle of the curve, really the lower end in the middle of the curve. So the 1-year T-bill rates come down from just over 4.2% to about 3.6%. Talk about the 10-year, that's gone down from 4.8 all the way down to 4%. And then you see the front end of the curve still right there at that 4.25. The back end of the curve has come down. The 30 years come down from about 4.8 to about 4.65. So it's been interesting to see the change of this yield curve. Now, the Fed, what they control is really the very front end of that yield curve. The overnight rates is really what they're changing. So as they decrease interest rates, they'll take that red line down, is the way to think about this. So one question that I would tee up for you, Jim, and this is a question, is that, okay, well, if the Fed decreases interest rates, because of all the things we've talked about, it decreases the cost of borrowing, it generally can increase the value of some of the assets, such as real estate, because it influences cap rates, stocks, because it influences the discount rate. You know, is there a lot more spending, investing, borrowing, which then could hypothetically increase inflation? And that's the trade-off that potentially is being made here. So curious to hear your thoughts, and specifically as part of this too, is if you're in the government seat, how does this impact, the budget?
Yeah, well, that's a lot. I mean, one thing is, as I said, they're probably changing these rates slowly and gradually over time, because if they change them too fast, then you're right, it overheats the economy and there's too much borrowing, and then they create these asset bubbles that we're always concerned about. As far as the federal budget and deficit, interest rates can have a huge impact, because now we have debt service and we have interest that we have to pay for all this debt that we have, and higher interest rates make it problematic for our debt in our country.
Yeah, and I think one thing that's interesting is that the good news is that if interest rates come down, the debt is constantly having to be refinanced. Ideally, that the 30-year rate, though, may stay higher for longer, because really the rates will stay higher if other people demand a higher interest rate to hold the United States government's debt. And so that's the fear, is that with our debt being so high, other people say, wow, there's actually some risk here with the United States government. Therefore, I need to get compensated for this risk, and I get compensated through getting a higher interest rate. So that's the fear, is that if there's more inflation, if there's more growth, does that then just lead to more debt? More debt means higher interest rates, and then we get in this perpetual loop. So one thing that is interesting, we got $36 trillion of debt, and as we're talking about the interest cost on the debt real quick, right now it's 3.1%, meaning that our net interest expense as a percentage of GDP is 3.1%. So essentially 3% of all of the government, the gross domestic national product there, is going out the door to interest expense. That's projected to balloon to 5.4% over the next 30 years. And as we have a chart here that we can throw up, this is from the CBO's most recent projections, and you can see the historical percentage of GDP going out the door in debt as interest payments specifically, and then you can see the projection going here, and really you can see the pink, which is the net interest outlays, really blowing up. And that's because, yes, our debt is ballooning, but also the interest rates are way higher than they've been in the past. Yeah. So that's why these interest rates are huge, and not just as an entrepreneur, but just as a country and a government. And when you have this amount of debt, just like if you have a massive mortgage and you have to pay 7% instead of 3%, your payment looks a lot different, and the government's starting to feel that. Yeah,
good point. And, just for the listeners, if you don't know the difference between deficit and debt, deficit is year to year, like in a single year. Do you have a surplus? That means you have more revenue coming in than you have expenses. Or do you have a deficit, which is you have more expenses than you have revenue? And we have, for many, many years, the U.S. government has had a deficit. And then they accumulate debt from that deficit every year. And that's the $36 trillion that you're referring to.
Yep. All right. Well, let's transition. So Washington will continue to fail to grapple with the fiscal time bomb. We know that for sure.
Yep.
Smart entrepreneurs know how to stack different tax strategies and structure businesses appropriately to minimize their tax burden. And we talked in the last 2 episodes about the One Big Beautiful Bill, or OB3, the new tax bill passed on July 4th. I want to talk through 2 specific strategies and how they're getting stacked together. So we're going to call this the Billionaire's Playbook, because these are strategies that billionaires often use, but so can entrepreneurs, middle market entrepreneurs. We're going to go through these 2 different strategies, QSBS, Qualified Small Business Stock, and the Qualified Opportunity Zones again. I know we touched on those last few podcasts. And then we're going to use an actual example, because this was inspired. I talked to an actual software entrepreneur who was actually doing this. He did this strategy. And so I thought it was pretty badass. I don't want to break it down.
Yeah, let's do it. And by the way, one thing that I think we should just say in general is that too often entrepreneurs run around and they do this tactic or that tactic.
Yeah.
And there's no overall strategy and there's no coordination of everything.
Yep.
And it's like the quote I like to use from The Art of War: tactics without strategy is the noise before defeat. So just running around and taking these different strategies or tactics and kind of mishmashing them together. The magic is in all the things going on in your situation and having these strategies work well together. So I think it's great that we're going to show these stacking type of different strategies on top. But that's kind of a microcosm of what you should be doing in every area of your finances. Should be a well thought out plan that works together, not just a strategy here or a tactic there.
Yeah, I agree. And I think oftentimes we see people chasing what I'd call like a tax product of just something that's artificially created just to, artificially reduce taxes. But at the end of the day, to me, the whole goal is to build wealth. I mean, isn't that what we're actually in the game of doing, of building wealth, protecting wealth, managing wealth? And taxes is just a drag. And so if we can reduce our taxes, then that allows us to build more wealth. And so it's just a means to an end. Instead of just chasing these kind of tactics or strategies, these are ways to structure your business appropriately. And they're not necessarily just
along
products.
the lines of what you just said, I think as a business owner too, we've seen business owners where they're constantly chasing revenue. I just want to make more money, make more money, but they're not increasing their EBITDA or their profit, and they're not increasing the intrinsic value of that company for a future exit.
Right.
And just chasing revenue numbers may be cool to brag to your friends about, but you're not building true wealth in the company. And the same thing in your private life, in your personal life. Entrepreneurs so often they have all this money flowing around, but they don't have a strategy or a plan to really build true wealth. And that's the game, is building true wealth. That's what we're all after.
I like it. The only thing I would say is that if you're in SaaS, don't listen to what you just said, because you're generally selling off of revenue multiples, not EBITDA multiples.
That is true.
But,
which, by the way, even in SaaS, it's not as much as it was.
Yeah, it's true. Times have changed.
Yeah, it used to be, 18, 20 times revenue with some of those exits we saw.
I wouldn't know. I wish my business was a software business. All right, let's talk through QSBS. So let's just remind the listeners here, Qualified Small Business Stock. This is for C corporations. You have to have less than $75 million of assets on your balance sheet to be a qualified small business. So that's how they define small business. You have to have, again, be a C corporation. There's certain industries that this doesn't apply to. If you're in consulting, if you're in hospitality, you can't qualify for this. And really what it says is that, hey, when you sell your stock and you hold it for 3 years, you get a $7.5 million exclusion from gain. If you hold it for 4 years, you do, I think it's, what is the math there, $12 million?
Yeah,
75% of 15 million. I don't know what the math is there. If you hold it for 5 years, you get 100% exclusion, or $15 million on the $15 million gain there, and then or 10x your basis.
By the way, next time it's better to say it's 15 million and you get 50% after 3 years, 75% after 4, then 100%, because then you don't have to do all the math.
Yeah, well, we didn't do the math. I tried, but I couldn't do it. So that's qualified small business stock. So again, really good for businesses that are looking to sell in 3+ years. That's kind of the gist of it. Now we're going to stack that with qualified opportunity zones. As a reminder there, you can roll capital gains into these designated areas called qualified opportunity zones. You can also create a qualified opportunity zone business. You can actually operate a business in these specific geographic areas that are designated by the governors of every state, and they're low census tract areas. The whole idea from Congress is, hey, let's push capital to be invested in these low-income areas and make a tax incentive. So that's really what the qualified opportunity zone is. And then if you roll your capital gains over, you don't have to pay taxes for 5 years. You get to kind of punt on paying the taxes. So it's a deferral technique. You get a partial step up in basis, really said another way, a partial elimination of taxes, 10% by default, unless you're in an urban area. Then it's a 30% reduction in the taxes that you have to pay after that 5 years deferral. But then the big kicker is if you hold it for 10 years, whether it's property or the business in this area for 10 years, no taxes due at sale. So again, they're trying to incentivize long-term capital flying into these low economic areas and sticking around for at least 10 years. So these are the strategies we're going to dive into. What did I miss here to set the stage?
No, I think that's exactly right. I think all those are, and it's interesting on the QOZ, they actually in the law, it's just a fun fact, is they will not increase your basis after 30.
Yeah, it's weird. They're like forcing your money out after 30 years.
After 30 years. So if you put $1 million in, sell it after 10 years for $2 million, no taxes on that $1 million gain. But if you hold it for 30 years and that $1 million grew to $10 million, now you pay no taxes on that $9 million of gain. But they won't keep doing it after 30 years. So you can't let it go on for 50 years or pass it on to your family that way.
Which is weird because you could just sell the property, you would pay no gains, take your money, and then just go do it again, I guess.
Yeah.
Well, I guess you wouldn't really know how to do a qualified opportunity zone because you have no gains, so you're not something to defer.
That's right.
It's interesting.
Yeah.
I wonder why 30 years kind of seems arbitrary.
It is, like a lot of the tax law.
All right. Well, the last piece that we're going to break down, because this is going to be used in our example, is an F reorganization. And an F reorganization is really a way to do a tax-free restructuring of your business, because a lot of entrepreneurs we see are taxed as S corporations. They're an LLC. They pop it open with their state. They eventually, file Form 2553 to elect to become an S corporation because they hear that, hey, I can save some money on taxes. And that's true. But if you want to do that qualified small business stock strategy, as I mentioned, you have to be a C corporation. So how do you go from an S corporation to a C corporation without paying taxes or creating a tax bill? It's called an F reorganization. And so what happens here is that if I am an S corporation and I want to flip to become a C corporation to start my 3-year clock, 4-year clock, or 5-year clock to become qualified small business stock, I can do an F reorganization. And then the way that it works is you do a valuation. You got to get an independent third-party valuation of your S corporation. And you're going to want to do this after July 4th, 2025, because then you qualify for the new and improved qualified small business stock. And then you're going to get either the larger of, again, that $15 million if you hold it for 5 years, or 10x your basis. Your basis is the fair market value of that S corporation that you've then contributed into this new C corporation. So as an example, if I'm worth $10 million, I do a third-party valuation, I'm worth $10 million as an S corporation. When I convert it to a C corporation, now when I sell, I get the larger of $15 million if I hold for 5 years, or 10 times $10 million, which is $100 million completely tax-free. The nuance is that first $10 million, that is going to be all taxable at capital gains tax rates. So it's only above that $10 million valuation, all that upside is going to be 10x. So give you a little nugget here.
You would take that all day long.
Take that. If I'm going to sell for 100 mil, I'll gladly pay 10 mil, the first 10 mil of taxes, and not pay down the other 90.
And you said to do the F reorg, you have to do it after July 1st, 2025. So, I think people have a pretty good shot at that happening. 4th of July.
Yeah, 2025.
Yeah.
Yeah.
Which, unless they went in a time machine back to take our advice, I think you probably didn't have to mention that, but still.
It could be in the upside down world. I don't know. So these are the different strategies we're going to talk through of how to stack these. So let's now go behind closed doors here and talk through an actual case study. So I'm going to keep this business name close to my vest because this is non-public information, but let me break down. This is an actual client. So we're going to go back in the time machine. This is 2023. So it's going to get a little bit confusing because the qualified small business stock rules were rewritten with the new tax bill. So when this entrepreneur did this, it was the greater of $10 million or 10x your basis instead of now it's $15 million or 10x your basis. So this entrepreneur sold his SaaS company for 15 mil. All right. So he sold his for 15 million. So he had these capital gains. He wanted to reinvest these proceeds. He was trying to figure out what to do. And the private equity company that he sold his software company to for 15 mil had another company in their portfolio, software company in a Dallas, Texas opportunity zone. And it was not doing very well. So private equity came in, bought this other company, completely unrelated, and it was just like running into the ground. So what this guy did is he said, okay, well, I got this 15 mil of proceeds. He took 6 million of that, and he went and bought that software company that was failing from the private equity company. And then he opened up shop in Dallas, Texas, and in a qualified opportunity zone in Dallas, Texas. So he set up a QOZB, which is a qualified opportunity zone business, bought it from again, private equity. Private equity bought it for 25, and then they sold it for 6. So that's where we're at now. So an entrepreneur sells for 15, takes 6 million of his proceeds, and goes and buys a new software company and he sets up shop in a qualified opportunity zone in Dallas, Texas. The other 19
and that's
million.
because he's an expert in that space.
Yeah, he built a SaaS business and he sold it. So he's
I would say don't try this at home unless you're an expert.
Yeah.
Buy a failing business if you don't know how to turn it around.
100%. The other 19 million, the other 9 million, this guy just took to the bank, paid taxes, whatever, right? We're not going to worry about that.
Right.
So he bought this business. He then does an F reorganization because this business he bought was not taxed as a C corporation and he wanted to qualify it for that Section 1202. So he does an F reorganization to start his 5-year clock to convert this to a qualified C corporation. With the F reorg, you keep your EIN, you keep your contracts in place, so you don't have to worry about any of that kind of stuff. So now he owns the qualified small business stock in a qualified opportunity zone. All right, so that's kind of where we've got now. So when he did this, again, he just did the flip to the F reorg right after he bought it, so it was valued at $6 million. And so now when he sells, he's going to get, again, $6 million as his new basis in the C corporation. So 10 times that, it's $60 million. So again, when he sells this new business, he's going to have to pay taxes on the first $6 million, but then anything above that $6 million, up to $66 million, because it's $60 million of growth, completely tax-free. So let me pause,
powerful.
Take a breath, and then we'll kind of play out some scenarios here of how this could actually quantify the savings this guy can potentially stack.
Yeah, that's incredible. And so obviously he's going to defer the capital gains for 5 years.
Yep, on the $6 million.
And then he's going to get, now he's involved in this business that he's going to get no capital gains if he holds for more than 10 years.
Spot on. So I kind of put together just some rough numbers on 2 different scenarios. So let's assume that he sells his business for $25 million beyond 2028. The reason 2028 is because, remember, he did this conversion in 2023. So in 2028, he meets that 5-year rule. So then he gets that $10 million or 10x basis exclusion. Again, why is it 10 million instead of 15? Because this was pre-July 4th, 2025 qualified small business stock.
Right.
So he's going to pay taxes. If he sells for 25 million, he's going to pay taxes on the first 6. He'll pay long-term capital gains, so that's 1.2 million in taxes. He's not going to pay any more taxes on the other 19 million, so he's going to save 3.8 mil. So that's a conservative scenario. He saves the $3.8 million scenario or taxes, plus he deferred another 1.8 or 1.2 million dollars on that $6 million for 5 years, right?
Right. So he could have invested that, even if he put it in cash or CDs or something. He's going to be making money. Hardly ever in the tax code can you make money off the government's money while they're waiting for it. Right?
So true. Yep.
So that's really powerful. I like that. And you know what? 3.8 million. I always say 3.8 million here, 3.8 million there. Pretty soon you have some real money.
Yeah. Pretty soon. Yeah. Love that. All right. So let's do an aggressive scenario. So let's assume this guy scales this thing, sells it for 100 million. Again, in 2028. So again, he's going to have to pay taxes on the first $6 million. That's $1.2 million in taxes. He's not going to pay any taxes on the next $60 million because, again, it's his $6 million times his 10x. So from 6 to 66, 0 taxes there. And then he's going to have to pay taxes from 66 to 100 million. So all in, he's going to pay 40 million out of the 100 million is going to be taxable. So he's going to pay 8 million in taxes instead of 20 million in taxes. So $12 million of total tax savings. And this is just for that qualified small business stock, right? Now, where this can get crazy is if he holds that stock for beyond 10 years, completely tax-free. Because remember, he did it in a qualified opportunity zone, so he deferred the taxes on that $6 million purchase, which is 1.2. So he deferred the taxes there. If he holds that for beyond 10 years, which is beyond 2033, no taxes at all. So when I talked to him, I was like, dude, you are stacked. Like, what's the game plan? He's like, well, if someone offers me 50 or 100 mil, of course I'm going to take it. I'm not going to wait the full 10 years. But if I don't find a buyer, then I'm just going to wait 10 years and then I'll pay no taxes at all. So he's like, either way, I'm set up pretty good, right? And I'm like, you are set up pretty good, my friend.
It's like pay me now or pay me later. He's going to get money either way, and he's going to get a tax relief benefit from the IRS based on these laws. And the longer he waits, the more a benefit he gets. That's pretty powerful.
Yep. So all about structuring. I think that's the important thing here. It's like this entrepreneur had the foresight to be connected, had a liquidity event, set himself and his family up for forever, which is awesome. But then as he thinks through hey, what's my next season? Understanding hey, what is qualified small business stock? We just described exactly how entrepreneurs can use it. And what is a qualified opportunity zone, right? And for him, it met his fact pattern that he wanted to set up shop in a qualified opportunity zone in downtown Dallas in an area. His engineers were willing to come in and work every day there. So it all worked out really well. So having the foresight, that was what is so cool, is that he wasn't reactive. He knew the road ahead of him and the lay of the land, and that's what I think was very, very awesome.
Yeah, I think there's 2 things to touch on here from a planning perspective. One, is so often we see entrepreneurs not plan the exit very well.
Yep.
So they don't do good books and records. They don't have their P&Ls and their model P&Ls. They don't get good deal terms. All those things that they didn't do. They don't have a leadership team that can run the company without them. All the things that they make in mistakes in getting the highest price for their company. But then they don't do the planning about how do they structure it for the future and for the exit and for the taxes and for the asset protection. And all those things have to be thought about, because sometimes entrepreneurs do all the exit stuff right. They get a huge check. They owe all these taxes. There's no game plan. And then they miss out on things like this stacking strategy.
Yeah. Yep. If you have, ideally 5 years, if not that, at least 2 years head start, you can't do qualified small business stock, but you can still do a lot of cool stuff.
Yeah, I can't tell you how many times I bumped into an entrepreneur who's like, hey, Jim, I think I need your help. I go, why? I just got an LOI on my company. And they've done no planning. Just out of the blue, someone said, I want your company, and they gave them an LOI. That's the worst scenario. I mean, hey, maybe take it and make a bunch of money, but it's the worst scenario. They should have been thinking about that years in advance.
Yep. Still some cool stuff that can be done even for a scenario like that, but you're probably
Even
restricted to
post-exit.
10 to 25% of the playbook that would otherwise be available to you.
100% true. Yeah, I always say that the playbook's wide open if you go 2 to 5 years before.
Yeah.
The playbook gets shrunk if it's year of sale before sale, shrunk more year of sale after sale, shrunk even more year after sale, right?
Yeah, not like you do there. All right, last visual we've got here on this. I just have put together a visual just for those at home here, watch it on YouTube. What does this look like in terms of the flow chart of what this entrepreneur is doing? That, again, is really awesome. So just starting through step by step, breaking it down of the OZ selection, doing the qualified small business stock conversion through an F reorganization and stacking it, and then just kind of showing some numbers on what this looks like. So I was pretty impressed. This guy is he's a player, so I was proud of him, and I'm hoping that he has this liquidity event, right? I mean, there's always the risk that he can't sell the business or he can't turn it around. I mean, that was a risk, but
absolutely,
if he turns it around, he's going to make a bunch of money. Good for him.
Yeah, I love it.
All right, so let's talk through from the fractional family office floor. So just some things that we're doing, and since I'm the one who put this together, I've been beta testing Perplexity's new Comet browser. And so this is in lieu of Chrome. Maybe some people are using like Firefox or DuckDuckGo or anything like that, but I've been using Comet. So that's, again, Perplexity. They have a Comet browser, and it has been awesome. And then it came out in the news about a month ago. They made an unsolicited bid for Google's Chrome, or Alphabet's Chrome browser, for $34.5 billion, which has since been rejected. But what browser do you use, Jim? Are you like on Firefox or Internet Explorer or
No,
something?
I use Perplexity.
You use Perplexity browser?
I do. I use.
Yeah, what's it called?
I don't use Comet. I use Perplexity.
Oh, okay. Well, Perplexity is not a browser.
But that's what I use to like search for stuff.
Oh gosh, yeah. This is like, you know what? We got to call your pigeon back here to get the messages.
I use Google too. Isn't that a browser?
No, Google Chrome is a browser.
Oh, yeah, that's what I use.
Well, I'm going to take over the rest of this segment because this is not. You're not a lot of value here.
I represent a lot of the older people out there.
More experienced is what we like to say. So, anyways, what's really cool about this Comet browser? I've sent it out to actually multiple entrepreneurs that we work with or clients of ours. But there's a built-in feature where it can automatically summarize exactly what's on your browser page. So if I go to a website, and let's say it's super long, or there's an article, or there's an embedded video, I can click a summarize button, and then it just summarizes every single thing. So instead of me having to read it, I can just get the summarization, which is awesome, and then you can interact with that summary. So I can say, okay, this is very interesting. Can you give me more information about this one point? And so it's just a way for you to kind of get 80% of the information you want by spending 20% of the time. It's like the Pareto rule. So that's been one of the coolest features. It's built into the browser.
And how do you change from a Google Chrome, as you call it, to to Perplexity Comet?
Well, you have to go into Perplexity. You can Google Perplexity Comet, and then you're going to go click on a landing page. You're going to download it, and it's going to be like a new application on your computer. And then you just have to use that as your primary browser. So you can like set it as like your default browser. So anytime you just try to open up a link or anything, it's going to automatically open up in the Perplexity Comet.
And is there a cost to Comet, or do they have a?
It's free. Well, this is what we're going to talk about.
Okay.
We're going to talk about the business model here because it's pretty sweet. But then obviously, if you're not paying, that's because you are, you're kind of the lamb if you're not paying anybody anything for something.
Got it.
So as part of this, another really cool feature is there's an AI assistant that's built into it. So, for example, if you need help with like, hey, map out, I want to walk from this to this on Google Maps, map it out. Like it can do little tasks for you as well. You can like, ask it to do kind of simple things. But I've used it to like quiz me on certain things. So maybe and there's like a 40-minute YouTube video, I'll get a summarization on it, and then I'll say, okay, hey, I want you to build multiple choice quiz questions based off of this and make them very challenging.
Wow.
And then it'll create quiz questions, and then that's a way for me to challenge myself to see if I've grasped the information or if I need like more help. Or for example, when we're building like our new 16-week associate onboarding program, I'm building quizzes based off of the content that's on the page there, and it just does it like that.
Yeah, well, my friend Jim Quick says that self-testing is one of the best ways to learn. So I love that aspect. Is there something I don't know? Is Perplexity Comet a sponsor of our podcast or something?
No, it's not. It's just pretty cool.
I don't think we have any sponsors, do we?
We have 0 sponsors.
Okay.
No, we actually pay money to produce this podcast.
That is true. Okay, well, maybe if someone from Perplexity Comet hears this, maybe they want to sponsor this.
Maybe.
Based on that plug.
Yep. So big productivity gains. I have sent it over to multiple entrepreneurs. I've gotten good feedback. They love really the summarization feature. So again, Perplexity Comet. Yep. No referral fees, no kickbacks there. But let's talk through. So Perplexity again made an unsolicited bid to buy Chrome from Google, and that was because, remember, there was the antitrust case, and then there was thoughts that maybe Google's going to split into its pieces. So they were going to raise a bunch of money to try to, put a little bit of pressure on Google. But then just recently, the district judge Amit Mehta ruled September 2nd that Google can keep Chrome and Android, and really he cited that because of all of the competition from OpenAI and Claude, and I'm curious to see if you're changing your search and purchase behaviors, but that Google is already seeing a downshift in, well, I shouldn't say a downshift in ad revenue, but in traffic. And I know I am using ChatGPT and Claude to actually help make more purchase decisions, where I used to all go through Chrome, right? And so I'll say, hey, I need help finding this. Give me these 3 options. Here's my zip code, whatever. And then it'll give me 3 different options, and then I'll call them or go look at the websites or whatever, where I used to do that on like Google Maps or on Chrome. So that's where I think the judge was citing that there's some of that traffic's already migrating off of Chrome and Google Maps and their platform to AI. And so because of that, I don't need to break these guys apart, because capitalism and the open market's doing its own thing. Like their lunch is getting eaten, essentially.
Yeah, that's really interesting. And I, along the lines with you, I use Claude and Perplexity for stuff like that more than Google anymore. So maybe not that I am a leader
we can tell.
that they're looking at for what the world is doing out there. But yeah, it's really interesting. And, just as a side note, judges have so much power in this country. I'm wondering, do we really have that good a process to get the best people as judges? I just don't know. I mean, I've been involved in cases in the past where I was a trustee for a family, and there was this big court case in LA, and I had to go, see all these judges. Not me, I was just a trustee there supporting the family. But I was shocked at how terrible some of these judges, and I don't think LA is the only place in the country that has bad judges, but anyway, they have a lot of power, and I just don't know that we have some process to get the best of the best. I mean, we have a great process to make sure that the NFL starting quarterbacks are probably the best at that position of anywhere in the world, but I don't know what we're doing to get good judges.
That is a tangent I did not expect to go on today. And I know as much about that process as you know about Comet and other web browsers. So I can add zero value to that.
I'll just put that out in the world that, hey, let's make sure we have a good process to get good judges, because they have a lot of power, and I don't know that all our judges are that good.
I think we say that about a lot of elected officials.
That's true.
So closing loop here, Google stock did jump 8% after that worst case penalties in the antitrust case decided not to come to reality. So good news for Google. They get to keep Chrome. So the market liked that. Bad news for Google. There's the Comet, Perplexity. There's other people coming into their space. So they've got to turn their machine around a little bit, turn the beast a little bit. But we were talking about why would companies want to do this? And if you think about it, that if you are Perplexity or you are ChatGPT, they still are missing out on just typical stuff that's happening in your browser, because they can't see what websites you're going to. They can maybe see if you're clicking through links using them to search, then they'll see, hey, you bounced off of us because you clicked this URL I put in there, but they can't see where you're actually going. So they don't know, are you going to ESPN a lot? What websites are you going to? Whereas Comet now as a browser knows it's getting data on me. So it's eventually going to get into advertising, because that's the future of, I guarantee you that all of these different companies are going to have, like, we're paying subscription fees for Claude and ChatGPT and all these different resources, but they want to start going after Google's advertising network, because once they own the browser, they can see, oh, I know what this guy likes. I can now target him specifically with ads. So that's why I think Perplexity is getting into the browser space.
Yeah.
Because it's going to give them really, really good information. They're not only going to see what I'm typing in and questioning and talking to AI about, which is going to give them a lot of information about me. They're also going to see, like, what websites he's browsing, where's he shopping, what's he doing, and then I'm going to get target ads. That's the future.
Yeah, I agree. And, in a way, it's good that Google has so much power. It'd be good to diversify some of that power away from them. And I don't know. Google stock, you think it's going to drop now that I'm moving from Chrome to Comet?
When they hear that you're moving away,
Yeah.
I mean,
that could be a big problem for them.
Could be. I'm still waiting for your carrier pigeon to come back here, and he's probably going to hit the door on the way in. Get your emails from earlier today. Well, that's what we got today. So yield curves, tax strategies, browser wars, something Jim knows nothing about, judges, something I know nothing about, or I would say, you know what, that complexity creates opportunities. So for entrepreneurs, let's wrap up here. What is your biggest takeaway from our conversation today?
I would say having an overall plan to stack strategies.
Yeah.
Rather than just use one strategy, stack strategies and think well in advance so you can really craft the best plan.
Yeah, for me, interest rates. I'm really excited to see, as we talked about in a previous episode, about the extend and pretend, the issue in multifamily. Interest rates were a huge driver of multifamily and apartment buildings going poof and blowing up, and a lot of investors or limited partners losing their money. I'm interested to see what happens with interest rates and where do interest rates settle in after all of this. I was just talking to a private credit manager yesterday, and he said for every 0.25% or 25 basis points the Fed cuts, his yields are going to go up by 0.14%, and that's just because he's going to decrease his borrowing costs, and because they use some leverage there.
Oh, right.
So it'll be interesting to see that some of these net spreads on these different private credit investments will go up. So there's just all these different ramifications. It'll be very interesting to see where we settle out with the Fed and their cutting cycle.
Yeah, I'm looking forward to it. I think there'll be some good things from the Fed's cuts that will, I think, go on for at least a year or two, probably longer.
We'll see. Hopefully not too much cuts, because that means we're probably in a bad situation.
Right. If they cut really fast, it's probably because there's an issue.
Yeah. Awesome. All right. Well, that's it today. Make Rich Real podcast. Jim, thanks for showing up casual on a Friday, and we'll see you guys next week.
Thanks for listening to Make Rich Real, where million-dollar businesses meet billionaire strategies. Please note the following disclosure.
This podcast is provided by Dew Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performances for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dewwealth.com, or upon request.